Welcome back to the Automotive Market Minute, in which may or may not take just over a minute. My name is Steven Georgella.
My name is Philip Trepetowski.
And I'm James Sivko.
We had a very, very interesting month of October, and as September was quite slow, we slowly crawled into October. Saw a lot of very interesting signs. We'll talk about the dealership performance across all Fountain Ford's clients. We're going to talk about national sales and inventory. We're going to talk about this recession we're right on the edge of. We're going to talk about these Fed rate cuts and what are the impacts of them, because of course, when you cut rates, it's going to be so amazing for all the car dealers. It's going to be amazing for the consumers. Or is it? That will be the question in which many people have been asking, and James and Phil have some amazing information to unpack what's really happening and what to look for in the months ahead. But we'll go over some of our dealership aggregate performance here for the month of October. So during the month of October, you're actually going to see here that leads were down month over month. You'll see that appointments were down 1.6%, but sure enough, we actually sold more vehicles and we had a bigger increase in actual used sales. Now, what's interesting here is if you look at new sales year over year, you're going to see them only about 1% off. And then you're going to look at used sales and you're going to see them up. Again, what we're noticing across the space is if you look at 12 months ago versus now, sales are not really off. But what you're seeing is grosses and then the expenses at the stores. Those are where dealerships a year ago, they were sitting there going, oh, I still have the high from COVID. I still have a lot of money rolling around. A lot of the problems that are inside my dealership, those cracks in the concrete, they're not expanding too much yet. But you give it some time over the last 12 months, and this distillation happened. And everything is kind of starting all the problems, if you will, are starting to rear their ugly heads. And this is where we called it months ago. Parity is reducing more and more and more. So we're seeing dealerships that are, they're underwater and they're putting their hand up and they're asking for a life jacket or a life preserver. And then you're seeing other dealers going, listen, I'm taking market share. I may not be making as much per car as I was beforehand, but I continue to take market share. And they're kind of looking left or right for other stores that might want to sell because they're ready to expand. But I'll let Phil and I'll let James here give you the details as to why these things are happening. What's important is that you realize why things are happening so that you can adjust your dealership, your sales team, your strategy, and then also what we believe is going to be coming ahead, because evidently we're predicting things faster than Car Dealership Guy, and I would like to make that call. We've done it now 3 times this year, and I have a feeling we might do it again this month just by looking at the smirks on Phil and James's face. Go ahead, gentlemen.
Before we get into some of that, I wanted to cover things from a national retail perspective. Here you have new retail sales on the left-hand side, and you can see that over the last 4 weeks, things have been trending up. New sales have been up year over year. And again, throughout October, from a national perspective, it looks like there was some progress made over September. On the right-hand side, you can see used retail sales, and very similar. There's starting to be some divergence from 2023. Used sales are in fact up again, up against September and up against last October as a whole. Now, looking at inventory, new inventory was up 8% in the latest week. That is now down about 14% compared to 2019 levels, but day supply increased by 7% over the most recent week, and it is currently at 85 days, which is about 14% higher compared to last year. Now, used day supply, that is down about 16% against last year, with used day supply falling down to about 27.3 days. And this is another chart that we have touched on in the past, but this is consumer sentiment. Consumer sentiment is started to really jump higher, and you can see over the last recent weeks and months, it's on a clear positive trend. Now, in the last couple of monthly market minutes, we have touched on some recessionary signals that have started to show, but we now have a new chart that shows GDP. And James, what is GDP telling us about some sort of recession that may be on the front line.
Real quick, if you don't mind going back one slide there, Phil, do you have any guesses? I just wanted to ask you. Do you have any guesses as to why the consumer sentiment might have jumped just so far to start out in November? I just wanted to ask.
We just got past an election. It looks as if many people have been fans of the results.
Oh, wow. Okay, fantastic. Go ahead, James. Mr. Sivko, did you have anything to add?
That's great. No, I don't. I think the people have spoken, and not just at the ballot box, but maybe they'll be speaking at cash registers soon with more frequency. So this is a welcome upturn in consumer sentiment. We have had a recession scare a few times this year. Certainly, we here at Fountain Forward, we're planning for a downturn soon. This is consensus economic real growth. So you have to add the inflation rate of about 2.5 or 3%, depending on how you measure it, to this number. And it looks like all of the economists on Wall Street think that we're going to have about 2.3% growth here in the third quarter and about 2% growth in the fourth quarter. That's kind of slow growth until you think about inflation. So we're still looking at nominal growth of around 5%. That's an economy that seems to be chugging along, although most of the chugging is taking place in increased prices and not necessarily unit growth or real growth as we have predicted here. So what happened? What's going on now in the economy? The Fed has adjusted short-term rates.
This is the juicy one.
Since our last market minute, Fed has cut 50 dramatically and then 25 more for 75 basis points of short-term rate decreases. That's all the way over here at the left. The leftmost piece, the intercept here is the overnight rate. And then the arrow sitting on top of the 1 month rate. And you can see it goes in months. And then over at the right, the rate cut really backfired because we all operate in terms of car loans in the 3-year, 5-year space. And so rates for 3-year and 5-year paper is actually up 75 basis points. So to many of us here in the car business, it's almost like the Fed rate cut is backfired. Now, there is one piece of good news here, and that is all the way over at the left is what floor plan is based on. So floor plan is based on kind of the 1 month, 3 month rate, and that indeed is down 75 basis points. So dealers are getting some relief on their floor plan, which is welcome, but consumers have got to adjust their expectations in terms of will there be low rate financing or will there be 0% financing? Those remain rare, and further rate cuts, it's uncertain what their effects will be on the 3-year, 5-year part of the curve, which is where all of our loans are. And so is this normal, right? Does this occur every time the Fed cuts rates? And the answer is no. This is since 1970 is this gray area. And this is the 10-year, which is pretty darn close to the 5-year. And I'm sure we're out there originating 7-year loans for cars. So this is actually close to the 3-year, 5-year part of the curve. And this move, which is in orange, is not normal. This is not a typical reaction to a rate cut. Usually the whole curve has got the Fed's interest rate path priced in. And so we really have to ask why. Right? Why is it that, this is 40 years of data in here. What the heck is going on that might be driving this? There are a lot of factors. One is the economy is hotter than you would expect. But if we go back to 2008, this is a great chart, dates all the way back to 1922. This is a chart that back in 08, everybody was passing around trying to figure out what the heck is going to happen. And this is total debt in the economy. These are households. These are corporates. This is real estate, both residential and commercial, and there's some non-financial paper in here as well. You take all of that debt, all the trillions of dollars, and you divide it by our trillions of dollars of GDP, and in 08, we had a really levered economy. And so we were given a giant deleveraging project. We either had to cut debt or the economy had to grow faster and to try to grow faster than debt. The fun part is it's now 14 years later. We've been on this project for 14 years. How have we done? Well, I kind of give us a C+, B-. Certainly, there's been some deleveraging in the economy. Certainly, there's been some growth in the economy. The economy is probably 30% bigger than it was in 2008. But one part of the economy doesn't seem to be helping, fellas. Any guess what that might be?
Okay, so one thing that I also found interesting was this. Mortgage rates have now gone up 6 weeks straight. So what I did was, is ahead of the call, I wanted to pretend I was James Sivko for a second. I did a little research. And what I found out was, and James, really, I'm excited about this one. I think you might be giving me a pat on the back next time I see you here. What I saw is that mortgage rates normally operate independently of the Fed. And it's more of the way banks see the long-term, how the economy is going to do long-term. And if they believe that there's tougher things ahead, that it normally sits up higher for longer. And so even with it now being 75 bips less than it was at the high, they're still sitting there quite skittish and going, yeah, but I mean, I hear that you guys are all hyped over here, but, and I feel like that's just a more realistic view of what's actually happening. And then my second piece is maybe I'm crazy here, but I feel like what Trump is saying and what his administration is saying is we have like a good 2 years to dig out of what the hell is already here. So like you can all be pumped up in the short term. This is not going to be a pretty 2 years. We don't have a sexy 2 years ahead of us, because like, even if they put in, if Elon starts working on government spending and, RFK goes and works on food and all that stuff, it's going to cost a lot in the short term to try to get all this stuff figured out. The US consumer is not in a great spot. And other countries, the consumers are not in a great spot. When I was just in Colombia, I looked at some of the prices from 4 years ago versus now. It's much more expensive, and their income is not proportionate to the cost. And so I just don't know any other way to go, man, if that's the way investors are seeing mortgage rates, that's pretty damn indicative of where they believe the economy will go, at least in the short term. So it's excited that we're at least addressing this disease that's there, but it's going to take 2 years to get rid of the disease. This isn't a quick pill that we can take. James, am I on the right track?
What makes this line go down? One of the things that makes the line go down is growth. You grow the economy, and that's the divisor. So this line will go down then. The other thing that makes this go down is if we can get control of government spending, that can help make this line go down. The last several Treasury auctions, 3 years, 5 years, 10 years, have all been messy. In other words, there's not that much demand for Treasury paper. And the reason why is because the auction sizes have exploded. Instead of us having to roll 30 or $40 billion worth of 7-year paper, all of a sudden the next 7-year auction comes out and it's 60 or 60 plus. And so the bidders are there. They're just not used to seeing these kind of volumes. And this is going to be with us for a while. The Treasury has over and over again over the last 4 years done nothing but finance with short-term paper. And any good Treasury secretary is going to have to bite the bullet. And I imagine the new administration is going to have a good Treasury secretary and try to issue some of this longer-term paper. And so households over the since 2008 have done a very good job deleveraging. Businesses since 2008 have also done a decent job deleveraging. It's kind of flattened out. But what hasn't helped here is government has swamped all of that. So if you look at the 2008 peak, about 3 3/4 total debt to GDP, and we're down to 3.5. Well, 0.6 of that has been increased government borrowing. And so what we may be running up against is there's just too much debt in the system. And the old Fed was able to cut on the front end and the back end would follow. Now maybe interest rates may just go somewhere that's inconvenient for practically everybody.
With that being said, we wanted to kind of end this with where current incentives are at. Now, let me just preface this by saying 0% incentives are coming off a 12-month low in October. 12-month low. 0% offers have declined every single month of 2024 besides 2 months, May and August. Again, coming off a 12-month low here in October. They are up a bit in November, but that is the trend of 0% offers throughout this year.
What's interesting is when we're going through this information, what we're trying to do is we're trying to let you guys know what currently is happening from a micro level, meaning from the 85 to 100 dealers that Fountain Forward has to be able to give you that information and then tell you what's going on from a macroeconomic view and then tell you what we believe you should do with this. Here's what we're seeing. What we're seeing is why would you see all this apprehension from a factory standpoint when it comes down to, you had a little bit during the springtime, February and March, of buying down the rates, trying to stir some business up from a new vehicle standpoint. And then it seems like you've had a lot of coasting since then. That's what it looks like across all of the brands, a lot of coasting. Well, now you have these rate cuts that have come in. And what James has brought up to everyone is when it comes down to auto loans, it's 3 to 6 years the vast majority of the time. Well, in 3 to 6 years, those rates are not down. They're actually up. Right. So from an automaker standpoint, if I'm the factory, I'm going, yeah, I still have to deal with this. And James, if I misspeak on any of this, please let me know. But I have this bank over here. I can't just call the bank all of a sudden and be like, I have when I was going to have to buy down the rate, I now get a 25% discount because when I was at 4%, now I was at 4.5. Now I'm at 3.75. I have less to buy down, if you will. That's not actually the case. Just because the Fed made the shift, it didn't make it cheaper for me, the automaker. The automaker, I actually am in a more expensive spot than I was before coming into November and December. Now, we're seeing through the first 10 days of November, we are seeing some okay signs across the board. Looking at we do a 10th, 20th, and 30th update. So we are seeing that new sales are up about 1%, but then used sales up 10.6% to start the month. So we had a jump during October and now another jump during November. So market day supply, as Phil had shown, is going down and used sales are going up. I'm sitting here going, okay, those new vehicles, they're not going to get better from an incentive standpoint. They're not getting any cheaper, and they're not going to buy down rates.
Average monthly payments, which had flattened over the last several months, are about to go up again and set new records. The combination of higher car prices, along with these interest rates that are starting to not cooperate again, means higher monthly payments to the consumer. So as we are restocking our inventory over the next several months, we need to be working backwards from, okay, this $120,000 piece of inventory, what do the monthly payments look like, and is that affordable? And when you're crafting your inventory, instead of trying to hit home runs on big, expensive vehicles, get those mid-size and get those medium-sized vehicles on your lot, because those are the ones that are probably going to move.
A little engine that could overhear, once you see a couple times that we tried to play Nostradamus and that we were right ahead of time, got to get a little excited about it. So with that said, what a fantastic market minute. A lot of different things happening with the election just finishing and us recording this only a week later. We're going to have some amazing information coming to December's our last of the year. And so on behalf of James Sivko and Phil Trevatowski, my name is Steven Georgella, and of course, if God wills, we will see you again next month on the Automotive Market Minute. See ya.